Somewhere in London, inside a heavily guarded government facility, massive machines operate day and night, tirelessly printing money. Every day, hundreds of millions of pounds are pumped into the economy. But here comes the twist. It's not even real money. The tangible paper cash, the bundles you can hold in your hand, makes up only a tiny fraction of the money that exists. Most of our money doesn't exist the way you'd think. It's just numbers floating in a digital ether, moving through servers, flashing in and out of existence at the whim of people you've never met. Every single day, billions of euros, dollars, forints, and other currencies appear out of thin air. They're simply typed into a computer screen. So how does this whole system work? And more importantly, how did we end up in a world where money is essentially a shared hallucination? Before money, banks, and nicotine-maxed financial brokers in Patagonia vests, there was barter. If a farmer needed a new plow, he made a deal with a blacksmith. There was no cash, no receipts, just a verbal agreement. I owe you one. This system, though romantic, proved to be incredibly inefficient. What if the blacksmith didn't want wheat, but that's all the farmer had? The economy needed something more universally accepted. So people began using goods as currency: grain, salt, cattle. These items had intrinsic value because everyone needed them. But trading cows was cumbersome, and lugging around sacks of salt wasn't exactly convenient. That's when metal coins appeared. Small, durable, valuable, gold and silver became the perfect medium of exchange. Trade flourished, empires rose, but gold brought its own problems. Transporting it was cumbersome and risky. People searched for a better way to store and exchange wealth without constantly hauling metal around. That's when the real magic began. 17th century Europe, London, Amsterdam, Venice, booming banking centers. The goldsmiths, trusted keepers of wealth for the elite, stumbled upon a brilliant little trick. Instead of withdrawing their gold for every transaction, people began using handwritten notes, debt certificates, representing a claim on gold stored in the vault. These notes soon became as good as gold itself. Then the goldsmiths had an idea. People weren't withdrawing all their gold at once. What if we issued more notes than the actual gold we had? And boom, money was born out of thin air. They started lending out those extra promissory notes, charging interest on gold that didn't actually exist in their vaults. And as long as everyone didn't rush back at once to claim their gold, everything worked just fine. Sound familiar? It should. This is quite literally the foundation of the modern banking system. Today, we call it fractional reserve banking. But it's just the same old trick in a fancy digital disguise. The banks don't actually have your money. The numbers on your bank account, they're just a promise, not a pile of cash waiting for you in a vault. Now imagine you deposit 1 million forints into your bank account. That's your money, right? Well, yes and no. Your bank doesn't just store it, it uses it. The bank keeps a small fraction as reserves, sometimes as low as 0% depending on regulations. The rest is loaned out. And here's the weird part. When a bank gives a loan, it doesn't subtract that money from existing deposits. Instead, it simply creates it. Your 1 million forints remain untouched in your account. But now the borrower has a fresh 900,000 forints in theirs. Money that didn't exist before. That new money flows into the system. The borrower spends it. The recipient deposits it in another bank, and the process repeats. More loans, more digital money created. Your original 1 million has now multiplied into millions circulating in the economy. But here's the catch. Only that first million ever really existed. The rest? Just numbers on a screen, backed by nothing but trust. When banks need more cash, they don't dip into their own pockets. They turn to the central bank, the European Central Bank, the Federal Reserve, the Hungarian National Bank. These are the institutions that can quite literally create money out of thin air. The central bank doesn't need deposits, it doesn't need savings, it doesn't even need a good reason. It can simply create new money by purchasing government bonds or lending to banks. That's how, in response to crises, billions of euros, dollars, or forints appear seemingly overnight. Not printed, not earned, just created. The banking system is a complicated game of musical chairs with cash instead of chairs. And if too many people try to withdraw their money at the same time, the game is over. We've seen it happen before: bank runs, financial crises, collapses. But wait! If banks can create money out of nothing, why can't they just end poverty overnight? Why do they auction off homes instead of canceling debt? Because banks don't create money for free. Every single forint, euro, or dollar they bring into existence comes with a price tag: debt. Money isn't just a medium of exchange, it's a promise to repay. And if you can't pay, well, things get ugly. Think about it. Almost all the money in circulation exists because someone, somewhere, went into debt. Your mortgage? That money didn't exist until you signed the loan agreement. Your student loan? Same thing. The government itself? The biggest borrower of all. The modern economy thrives on debt. New money fuels growth, innovation, and opportunity. But it all comes at a cost. The system depends on constant borrowing to stay afloat. If all debts were paid off tomorrow, the economy would collapse, because repaying debt removes money from circulation. In 2008, that system crashed. Banks, bloated on cheap credit, handed out mortgages recklessly. They believed rising home prices guaranteed profit, even if borrowers defaulted. But when housing prices fell, banks were left holding trillions in toxic assets. Then Lehman Brothers collapsed, triggering panic. Banks stopped lending. Businesses froze. The entire system nearly shut down. Central banks flooded markets with billions. Governments bailed out financial giants, but left ordinary people behind. Millions lost homes and jobs. Social services were slashed. The wealthy walked away richer. The rest paid the price. And in the end, nothing changed. Banks grew larger and riskier. From 2010 to 2015, Greece, Spain, and others faced their own debt nightmares. Greece suffered most. Hospitals closed, pensions halved, youth unemployment soared. The bailouts didn't help people, they saved French and German banks. In 2022, Sri Lanka became the latest warning. Years of borrowing ended in default, inflation, food shortages, and collapse. A nation literally ran out of money. Debt isn't just economic, it can destroy countries. Yet when cracks appear, leaders respond the same way: print more money, cut rates, and pile on more debt. Real reform is too painful for those who benefit from the system. Meanwhile, inflation erodes savings, wages stagnate, homeownership fades into fantasy. The elite, armed with bailouts and cheap credit, double down. The game never stops. And the house always wins. As Georgi Matolci said, the next financial crisis is knocking. The question isn't if, but when. And when it hits, those who never played the game will pay the price.